How do you read market structure? What is market structure? Do you know what market structure is and how to read it? In the 30 years that I've been trading, I've gone over this time and time again, where I've said all these little intricate things don't matter much as long as you know what's happening in the market and their strategy and how to make money. But I'm gonna go over market structure so that you get a little bit of a better picture of what it's about. And you do need to know a little bit about it. It's not unimportant. It's important to know a couple of things, a couple of basic things in the market. And at the end of the video, I'm actually going to show you the strategy that makes us money, the business plan that's going to make you a profitable trader in the markets. That's the most important thing. Actual squiggly lines are only 50-50. It's just a 50-50 trade because the market is made up of human beings. It's not made up of maths. It's not made up of algorithms, as they say. That's just the computer program that's showing you the high probability trade. The actual trading is done between human beings buying and selling things in the market. It's like any market. You walk into a shop, it's not an algorithm. It's a bunch of stuff that's for sale by someone and you're going to buy it. That's as simple as it gets, guys. But let's go and have a look at the charts. Let's go and check this out. But before we do that, it's Coffee with Rob. For those of you who don't know me, I'm Rob. And for those of you who do know me, I am still Rob. And it is Coffee with Rob. So let's go to the charts. Let me pull my little mug out of the way here so that you guys can see the charts. I'm pretty sure you can see the charts now. And you can actually see what's going on these charts. And that's the most important thing at the end of the day. What is market structure? Well, there's a lot of contention as to what the difference is between structure. But the market is a very simple thing. Effectively, what the market does, I hope you guys can see this, is it goes down, it goes down, it goes up, goes down, goes up. It doesn't go up in a straight line, right? At the end of the day, it goes down that way as well. So in other words, you could have a market which is actually doing this at the end of the day, going downwards. And they never go down in straight line, guys. They always make those little kinks in the market, let's say, those little differences in the market, let's say. Excuse me if I'm not looking at the camera, I'm looking at the screen so that I can show you guys what's going on. But obviously my picture's this size now, so it shouldn't really matter that much. Most important thing is that you're looking at the squiggly lines, of course. Now, this is just the system, guys. This is just the squiggly lines. This is just the little candles and the little lines and things that are going to give you the high probability trade. We trade with resistance. We trade with support. If you don't know how to trade with support and resistance, and you don't know how to trade with these trend lines in support and resistance or supply and demand, please go back and watch all my other videos. The videos are there. They're all there. Every single video shows you this. At the end of this video, I will give you the strategy that we use to make money in the markets. But what is structure? One structure is this. We trade with a trend. So the trend is, like in this case, there's an upward trend here. You're going to trade in that trend. Whether it be short-term, long-term, you've got to get a feel for this. This comes with experience, understanding the market and what you see. What we would look at is maybe something like the US 500. And then you see here, you've got this long downward trend. This has been going down for a long time. And you're going to trade in that trend to the downside. Before that, it was going up for a long period of time. So you'd have been trading up in that trend to the upside. For those of you who don't know how we get our levels, like I said, go back and watch my previous videos. So what is a downtrend effectively, or an uptrend effectively? An uptrend is this. You see it's gone up, it's gone down, it's gone up, it's gone down. What I'm going to do, I'm just going to draw again. Let me just find myself a little pencil here. What you see, it's gone up, it's gone down, it's gone up, it's gone down, it's gone up, it's gone down, it's gone up, it's gone down. That's structure. And at all of these down points, you would have wanted to buy, you would have wanted to buy, you would have wanted to buy at all of these little points as it's going up along in the structure. That's effectively what you're looking for. So all the way up here, you would have been buying. And then to do that, you're drawing in the levels so that you can see where the levels are, so that you can put the levels in and you can draw the levels in. A lot of people will say, can you do this in the short term? Yes, of course. Here's structure here, all the way to the downside, coming down. The first way that we trade, and the first structure that you trade with, is trading in the trend. And it's easy to trade in the trend because all you're looking for in a trend is where this is coming down. For example, and actually look for a better example of something going to the upside or the downside, a little bit more of a level. There's a nice upward trend, and it's even got some trend lines in already so that you can see what's going on. So if you've got an upward trend such as this one, where the market is moving to the upside, what you do is every time it hits the bottom, you buy, and it goes to the top, you sell. It comes to the bottom, you buy, goes to the top. While it didn't reach the top, came down. And when it breaks out of the trend, it gives you a big red candle here, which is telling you to sell. That's what we call a counter trend. What is it doing? It's breaking market structure. A lot of structure in the market is designed by patterns. For example, you get head and shoulders, cup and handle, flag patterns, and you can look at those patterns as useful to your structure, useful within a structure. What we look at is the basic structure of the market going up or the market going down. So what you've got here, you've got a bullish structure, a short-term bullish structure, and that structure gets broken and it changes structure. When it changes structure, what do you get? Let's draw a trend line in. You get a downward structure. So now that has changed structure to the downside. So now your structure is moving in the other direction. And if it breaks back through that structure, it's breaking structure again. So I don't want to confuse you with too many lines, but what you have here is a demand of money. So this is now getting in the way of your trade because this has now broken the structure. It's heading down. It's heading into that demand of money. What's it going to do? It's going to hit that. This is going to be like a support. It's going to hit that. It's going to take some money and maybe bounce back up. But it's still in that structure and only changes if it effectively breaks that particular type of structure. Now you're in that structure, you're trading in that structure, and it's trading to the downside. If it bounces off here, you know what you're doing. The structure is basically the lines that I showed you now. What actually happens, let me get a little pen here. You get this movement going in that area, and everything in there is in structure. And it only breaks that structure if it breaks out of that structural pattern. It could be a range. For example, if we go to, I think Brent crude oil is going to go, the US 500 is actually quite a good example at the moment as well. At the moment, the US 500 is effectively trading between 6,100 and 5,500. It's in that range. And every time it comes off the top, it goes down. Every time it goes off the bottom, it goes up. That is a range, and that is a structure on its own. And only when it breaks the structure to the upside or to the downside is it going to be any different. So your structure is effectively this. Take a pencil, draw it in. I'm just going to show you. So it's going from there to there to there to there to there. That's if it's trading in a range. That range is your structure. That's your structural range for that product. So it's staying in that range, staying in that level. It's not breaking out of that level, as we say at the moment. It could be just a flag pattern from a previous run, or it could be that it is just staying in that structure. Another good example of this is Brent crude oil. Brent crude oil, look at the structure on Brent crude oil. This is a range. In other words, every time it hits the support, which is at 70, it goes up. Every time it hits the resistance, which is at 82, it goes down. It ranges between 70 and 80 on a consistent basis. Did you know that Brent crude oil, or crude oil in general, ranges between 65 and 105 on any good day? Worst case scenario, 0 to 120. But in general, most of the time, on average, 80% of the time, it ranges between $65 and $105. You can be assured of that at any good time. And if you want to trade that, it's a cyclical commodity. And you can do that if you've got the money to hold it. That's what trading in a range is about. So that's the kind of structure you're getting from a, say, for example, Brent crude oil. It's in structure. Within that structure, you can counter trade structures. There's break of structure. When you get a break of structure, let me see if I can find one somewhere. A break of structure is when the price breaks out of the resistance and heads on to the upside. Don't know which one has actually got something like that at the moment. There's no real breaks of structure here at the moment. Gold has broken. This is in structure. You see it comes back, goes up, comes back, goes up, comes back, comes back. These are supply levels or demand levels of money on the way up that it comes back to take and moves on to the upside. I just want to see if I can find a product that has actually broken some structure, broken a support and resistance in recent times. Maybe if I take it to the day or a weekly, nothing there. Not getting a very good picture here. I'm going to have to look for something for you guys. Otherwise, it's not going to be able to show you the break of US dollar, Canadian dollar had a big break of structure. That was way back. No, that didn't work. Well, effectively what you get, let's take a look at this US dollar, Canadian dollar. It's in a range. It's broken through this level here and it's gone straight through. Now, normally on a break of structure, you wait for it to come back and retest and then continue on to the upside. You don't have to, I don't, but most people, as a general rule of thumb, you wait for a retest. Now, what happened here? Canadian dollar broke through its resistance and shot straight to the upside. Waiting for the retest would have been a good idea on this one because it came back, it retested, and guess what? Test failed, broke straight back through and went back into its range again. If it had bounced up here and gone up, this would have gone to the moon. That's break and retest. That's effectively what you get with a break and retest. Now, I know in the past we had some nice break and retests with some of the products. So there hasn't been here for quite a while. I suppose I could show you on the lower time frames. Nothing much here. These are staying in their range, not breaking out. But effectively what it is it breaks through the resistance or the support. Let's say it breaks through the resistance here. It'll come back, retest, and then go up. So effectively what you get, let me draw it with a pencil so that it gives you an idea of what happens. The price will break through, it'll go up. So let's say it breaks up, goes up, it'll come up to here, it'll come back down, it'll retest this area, and then it'll go up, and then it will continue going up from there. So effectively what you get is you get this breakthrough, goes up, comes back, retest, goes up, and continues on to the upside. That's a break and retest. You're going to get a few of those from time to time. They aren't always going to happen. And the reason I don't wait for break and retest on many occasions is because they very seldom happen. And in my opinion, most of the time, it just breaks through and heads on down. For example, this might have been some level and it's broken through and it's red candle. I'm in and it goes short and I take it. There is a big retest here much later on. Is there any point? Big red candle, down she goes anyway. You can actually stay in the trade. So there's three ways that we trade, guys. We trade with the trend, we trade in the range, and of course, we trade with the counter trade, the breakout of the trend, effectively when it breaks out of the trend. So what's the strategy? And the strategy is simple, guys. You need a business plan to make money in the market. That's as simple as it gets. It's not complicated. You can't just rely on squiggly lines to make you the money, because the squiggly lines are not going to make you the money. They just aren't. Win rates are not going to make you money. Trading is a 50-50 game. What's going to make you money is having a proper strategy in the market. And that strategy is this. If you have, let's say, a $25,000 account and you want to trade that account, what you got to do is have risk management. Number one, your first port of call is the risk management. I always use the 1% rule. In other words, I trade 1% of the account on every single trade. You can change that percentage if you want to, but I use 1% because if you take 10 trades, you only lose 10% of your account. If you lose all 10 trades, which you shouldn't, you should win 5 and lose 5, but let's say you did lose 10 in a row, at least you're still in the game. It's about keeping you in the game. This is not about making millions in a day. It's about staying in the game. Now what you do is you risk 1% per trade, which is $250 per trade. So every single trade you take, you try and risk the same amount. Doesn't matter if it's 220, 270, really doesn't matter. Just risk the same amount. Now, how do you take that trade? I'm just going to show you how to take that trade. I'm going to move this little guy back out of the way, and we're going to go to the chart, and I'm going to quickly show you how to take that trade. So let's say you wanted to take a trade on any one of these particular products. Let's say you want to go long on Brent crude oil. What you do is you say, all right, I want to go long on Brent crude oil. I want to take a stop loss, and I want it to be $250, about $250. My stop loss needs to be at 69. 69 would be a good stop loss. I'm happy with 69. I don't want to trade 295. I'm happy with $246.50 loss. Now I've got my trade, right? So my stop loss is at 69. I'm going to take my trade here. My take profit should be around, let's say 78. So what I'm going to do, I'm going to go in here. I'm going to put my take profit in at 78. And that's not good enough for a risk to reward But that said, we could actually go for the long haul. It is possible that it can reach the 81. Let's go for the 81. Let's go for the big one. Let's go for the $81 risk to reward, and then let's just buy it. Then all you got to do is place the order, boom, and you're in. So now what you've got a stop loss, which is at 69. You've got a take profit, which is at 81. You've got a cost, which is at 74. Why did I take this trade? It's broken through this demand level, and I was in the trade. I got taken out. I waited for it to break through this demand level, take the trade again, and we go long with a view to it getting all the way to the top. Hopefully. We don't know. It might not. But you're in the trade. You are now in the trade, and now you're following the trade. How do you follow the trade? This is a trailing stop that I put on here. The reason I put a trailing stop on is if I'm not looking, the stop loss will move up with the price. When the price gets about $200 in profit, what I'm going to do, I'm going to move it up to cost or into profit and let it trail up with it. If it trails up with it, great. If it comes back and takes that at cost, no big deal. I would have made that money if I was scalping anyway. This has broken its structure long ago, and it's heading up. It's breaking this structure and it's heading up, and that's how you take the trade, and that's how you follow the strategy. You keep the same amount on every single trade, same amount of stop loss on every single trade. Don't change your stop loss amount on trades. Keep it the same. That way, if you have a good trade or a bad trade, the loss stays the same. That way you keep an even kill, and you try and make more on your wins and lose less on your losses. If you want to know more about that strategy, please go and look at my other videos. Go back and watch the other videos where I go into heavy detail about these strategies. They'll help you, and they'll help you a lot. Don't forget to subscribe, and until the next video, come and watch the live shows. Cheers, ciao, and bye.